All right, so Lior Gantz, thank you for joining me. Unfortunately, we got started a little bit late, a little miscommunication error as far as linkage and whatnot. Technology seems to be getting more difficult, but as of now, I want to wait for another viewer or so before we get to talking or chit-chatting. But other than that, how's everything in your neck of the woods?
Michael, thanks for having me, and everything's all good.
That's good. So we have a couple of people joining us now. And so it's been, let me see, about maybe 4 or 5 months or so since we last chit chat in the mid-summer or end of summer 2017. So we're entering in 2018 now, and a lot of things have changed as the year came to an end, and a lot of exciting things are happening now as 2018 is in session. So before I actually get into deep thought, I wanted to touch on the primary topic that I think is going to be very important this year, and it has to do with the concept of inflation and how the Fed is not meeting their target and don't seem to know how inflation even works anymore. So share with me your thoughts on, will 2018 be a year of rapid or increased inflation beyond what we're actually feeling in our pockets? What are your thoughts on inflation in 2018?
So, Michael, I think what has transpired since the Trump election is a general change in how people feel confident about the trajectory of the U.S. economy. So inside the U.S., people have watched how the Obama administration and the Federal Reserve were creating a situation where business environment was very tough due to many regulations. And on the monetary front, they watched the Fed do extraordinary measures in terms of lowering interest rates and asset purchases in a time between 2009 and 2015. So during those 6 years, they've watched both the administration and their central bank signal to them, hey, a lot of things are wrong. We need to correct many things. We're going to do many emergency measures to make sure that we don't fall further into a huge hole. And when you, as either a citizen or a corporation, are getting this sort of signal from your central bank or from your administration, you are in a situation where it's uncomfortable for you to make large decisions, and you feel a lot of uncertainty. And what we saw, uh, sophisticated players in the market, so large institutions, funds, etc., they understood that what this means, this sort of a monetary policy, is that they'll get a lot of risk-free or risk um, lower risk returns in the marketplace because they know that the Federal Reserve is right after their assets, and therefore there's like a floor for asset prices. So corporations and large funds, they used this cheap monetary policy or cheap credit available, and they bought back their own shares of their own companies. So we saw CEOs doing that a lot between 2009 and 2015. And then you saw asset prices in the stock market go up substantially, making the rich even richer. So that sort of environment left the general population very, very, I would say, lost in the hands of monetary policy. Trump brought a wave of change. Now, fake, artificial, or real, that's another debate. But there is a wave of change within how people feel about the economy. If you look at the surveys of consumer confidence, both for individuals and small business, they're at record highs. So, Michael, the average person has not felt this good about the economy since the year 1999 in all surveys, and this is a huge difference. Now, Trump is deregulating. He is deregulating in the first year more than any other U.S. president in history, and this further fuels the feeling that the United States finally are, in an economic sense, moving forward. Socially, the last 8 years have brought wealth disparity. So if you take a cut of 1,000 people inside the U.S. and you take the richest one out of that 1,000, he's now richer than the bottom 900 in a 1,000 people group, and that's how Mexico looks like. That's not how the U.S. has looked like for the duration of their republic. Throughout more than 200 years, you haven't had this sort of a wealth gap. So, social wise, the availability of cheap credit to certain people, while the rest of the population were having to deal with all sorts of bank requirements, higher bank requirements for credit. That sort of, hey, he gets access to cheap cash, credit as an institution, and you don't as a person. That created a difference in what opportunities are available for people. And so this is one of the biggest things right now in the U.S. The the fact that a recession or a crisis is socially impossible. If the U.S. economy stalls, you're going to see problems like you saw in Europe. People will say, "Hey, I didn't go through this 8 year period where other people got richer and I got poorer, only to now endure a crisis or a recession. I'm not going to get fired. That's I can't." And so, going forward, socially, the United States looks very, very challenging. Economically, it's starting to look much better. There's real growth now in the economy, and it's important to say to your listeners, look, growth of asset prices is artificial compared to the real growth of the economy. The United States is a very well developed economy. It should grow at about 2.5–3% a year, because most people in the Western world, especially in America, have a lot of the things that other people in other places in the world do not have, like electricity, refrigeration, shelter, transportation, etc. So when you try to expand an economy like the U.S., what are people missing? What don't people have? They need to replace stuff, sure, but they don't need to buy them for the first time, like in China or India or Indonesia or all the other Asian countries that are now moving into their own industrial revolution. So going forward, you're going to see a growth rate in the United States. This is going to be 2.5–3%, and it's starting to naturally grow because, unlike 2009, now in 2017, the demographic group that has the capacity to grow the United States economy, which are the millennials, are hitting mature demographic years. They're starting to build families, so they would need to buy bigger homes. They need to buy cars. They need to pay for their children's lives when they start having kids, and then they have better career choices and better career paths because they're moving into that age bracket of 25 to 39, where people get more orderly careers and better paychecks. And so real growth is coming to the U.S. But it's important to understand that the stock market could be topping off in a year to 6 quarters. So in 4 to 6 quarters, the stock market could be topping off, and about a year to 2 years later, we usually hit a recession. And so in the midst of this growth, you will see the economy need to clean out any and all irregularities, and there's going to be firings, etc. Because you see, and even the unofficial or the alternative unemployment rate is very low right now. The official one is absolutely low at 4%, but obviously they don't count 100 million people that are outside the workforce. So when they look at their unemployment numbers, they only look at the 220 million people that they want to look at.
Right. All the statistics are so bogus. It's hard to tell what's the truth nowadays anyway. So other than just what you actually feel and what you hear from, your closest family and friends. You mentioned about how the economy, it could be booming for some, but yet on Main Street, a lot of people are strapped for cash and using credit cards for shopping and everything like that. So that's what my question about inflation for this year, because people are actually already feeling it now. Do you think it's going to get worse as the stock market continues to boom and all these indicators indicate a recovery type of thing? But do you actually think it's going to hit people in their pockets where they begin feeling it and it becomes more mainstream?
Yeah, I was just getting to that point, and the um, where it all ties into what I was saying. In December 15th of 2015, the Federal Reserve started raising rates for the first time after slashing them down to zero. And I'm talking about what's called the Fed funds rate. It's the artificial synthetic interest rate for the rest of the economy. Apart from the rate that they set, you've got the free market pricing in how much should a 2-year treasury bond yield, how much should a 5-year treasury bond yield, how much should a 10 and a 15 and a 20 and a 30, right? And then you got publicly traded companies or stocks, and how much are they willing to pay out in dividends. Those yields have a correlation with each other. Let me explain. When you're an institution like a pension fund and you've promised your retirees a 7% return a year in order to meet your obligations to them, you can't buy a 2% bond. You're going to get into a $4 to $6 trillion deficit for pension funds right now, and it's going to get much worse because in the United States, every 10 seconds somebody celebrates his 65th birthday. So it's an aging economy for about 80 million boomers. And so these pension funds have been in stocks for years because you're going to get that yield from the dividend, but then you're also going to get some equity growth. Now, when the 2-year or the 5-year bond yield more than a dividend from an expensive stock, then these institutions are starting to think, hey, if the bond that I can get from the United States government, which presumably is a safe asset, right? It's a safe haven for large billion-dollar pension funds and endowment funds, etc. If that yields more, then they start to get their money out of the stock market and into safe bonds or diversifying into both, which is something that they've not done in a long time. So when you see rates rising, that is something that provokes selling of stocks and getting their prices down and moving it into bonds. Like it says, and it's very true, interest rates are like weights on asset prices. So when you raise rates, you're going to lower asset prices. Now, the synthetic interest rate, what the Fed is controlling, if that becomes bigger than the 2-year and the 5-year treasury yield, then this really signals to the economy the stock markets have peaked, and that's about a year away. Now, what are you feeling in terms of inflation? When the central bank raises rates, think about yourself. Let's say you were shopping for a home right now, and your banker calls you and say, "Hey, the central bank just raised rates again. We're going to need to raise our rates again. Do you want to take out a mortgage now? I know you're interested, or in 1 year, the interest rates will probably be 1% higher." So when you raise interest rates, you're basically stimulating the economy. When you're lowering interest rates, you're telling people, hey, why don't you wait another year? The interest rate will be more attractive. So the only people who like, or the only portions of the economy that like when you lower interest rates is whomever can say to themselves, okay, interest rates are low enough for me to borrow and make a return on my investment. Now, those are corporations that borrow for cheap and then buy back their own shares, propping up their earnings per share. But as individuals, when we make loans, when we take out loans, it's usually not to get a return on investment, these are consumer loans. People take out loans for mortgages on their own home, which is not an asset because you need to pay all these obligations on it. The only way it turns into an asset is if it gains in price, right? And then you take out loans for cars and anything else. So it's just important to understand that right now the people that are getting stimulated are the general public, and the general public are much more influential on how an economy moves um, than corporations in terms of purchasing power. If all the people in the United States were to start spending, that will create a much more inflationary environment. Now you got people already feeling good. Now you got them scared that in 1 year they're going to need to pay more in interest rates than today. You're going to see more inflationary pressures in the United States of America. And then the other thing is that's important is tax cuts are creating a situation where there's more disposable income, and then that plays into, hey, I always wanted that vacation, I always wanted to do this, to do that. That is another thing that stimulates the economy. So tax cuts. Now, in my opinion, if Trump was looking to embark on an infrastructure spree, which the United States desperately needs, in terms of their report card on infrastructure, they're D minus for developed country. And so you really need an infrastructure boom to make sure that your roads and your bridges and your transportation and your water services, etc., everything is up to par with 21st century. And that is something that really creates real growth because it creates real jobs. And you really need it. You'll get a return on investment for your economy if you can move goods and services better. If your services are up to par, that is something that is very beneficial for the country. And so, if he can use the political capital of his tax cuts, so people are already having a much better approval rate of the president. He's now up to par with what Obama was after 1 year. So that's if you remember, there was a lot of hope and a lot of optimism. And so if he can do that and use it to roll out an infrastructure plan, that will stimulate the economy in even a better way. And you're going to feel that with inflation. So you're going to feel that at the oil pump. Oil prices are going to go higher. And then raw commodities are going to go higher in price because oil is the most important expense of mining companies. So when you mine any raw material, you're going to need to use these Caterpillar trucks. Those cost a lot of gas money. And if oil prices go up, you're going to need to charge more for commodities. So commodity prices go up, lumber prices go up for construction, copper prices go up for everything that they do, wiring and anything else. Silver prices go up, etc. And then food prices go up as well. So you're going to see that come in now because the growth in the United States is not that big, anyways. You're probably going to see it double from what it is now. So officially, it's like 1.5%. Unofficial, it's probably like 3 or 4%. So you're going to see it double. That's a big thing. If you see your US dollar declining by 8% a year in terms of inflation, that's pretty substantial for someone who has 200 or 300 or $1 million in his bank account and just loses 80 grand a year to inflation. That's massive. Right. So he's going to start spending it, right? He's going to say, I'm not going to lose it.
So that's
in 1 year.
So that's a massive loss of purchasing power in your money in the midst of the fact you said recession is coming. So we got inflation and recession, we got all those factors coming into play. So how will that impact the world? Because right now, Federal Reserve note the dollar is still the primary head honcho in the monetary realm. How will that be viewed outside with everything that's happening out east and all the plans they're having with moving the dollar from in usage and trade?
Well, you got to figure that in terms of the reserve currency, Michael, would you rather the US dollar be the reserve currency of the world or a Chinese yuan? Would you rather that a country that has proven itself to be quite stable in the last 100 years has the reserve currency as the world's largest economy, or a communistic country until 30 years ago, which was the poorest country on earth, now becoming the second largest country on earth, but has so many things that people don't know about it, and other governments don't know about it. So,
Right.
in terms of people saying a yuan-backed reserve currency, governments will not go for that. So the question is, what will replace the dollar? Because the dollar is becoming inefficient as
Mhm.
the world reserve currency. And that's the big question on the table. But until governments solve that, the last thing they want is some sort of a irregularity or a hyperinflation, like you see in Venezuela or in Zimbabwe as of late. You don't want your country to go through that. Is a
Yeah.
Not all politicians are looking for chaos in order to thrive. Uh, Definitely, there are factions of in any there are factions in any government that are sinister, but as a general whole,
Hello?
All right, Lior, sorry to interrupt. 1 second. We have a
yeah.
caller. Hello, caller. How you doing?
Baby, I know that I miss you. Okay, wait a minute. Give me to the phone. Give me to the phone.
So it sounds like someone's playing games.
Give me to the
Hello.
phone. Give me to the phone.
Well, my first prank call.
Don't worry about it.
Sorry about that.
For people who are interested in are looking to get financially educated and change their situation, change their circumstances in life, Michael, um, what they need to understand in 2018 and going forward is that the United States jobs market is changing. Um, Manufacturing is getting stronger, but jobs that the U.S. has lost to cheaper labor countries will not come back. There's no way that in the U.S. people will work for $2 and $3 an hour, and so the manufacturing capabilities of the United States are going to move into sophisticated manufacturing or automation, and the United States will need engineers and plant designers to meet um, new types of manufacturing. There's a resurgence in new industries. You got blockchain technology and cryptocurrencies occupations. You got cannabis occupations that are not going to get outsourced. And you saw the mother of all cannabis markets just go legalized 2 days ago with California. That's going to bring a lot of jobs into the United States. You're going to see other types of jobs going into the United States market, and demographically, you're at about 330 million people, and you're going to be 400 million people by 2050. So you're going to need more homes, more construction, etc. There are growth industries in throughout the republic's 200 something year history. Construction has been the biggest builder of wealth inside the United States. So that's something that is coming. In terms of how to profit from an inflationary environment, the number one thing, Michael, is commodities. And right now, for example, if you look at what we're doing at Wealth Research Group, 2 days ago, we covered our first ever copper company.
Mhm.
Um, the company started trading 2 days ago at 64 cents Canadian. It's over 90 cents Canadian right now. It had a huge 45% move in the last 2 days. You can get access to this particular company on Wealth Research Group slash inflation, and it's the only copper company which I've ever found attractive in 2 years of researching and publishing actionable um, information with Wealth Research Group. We are looking for 2018 to be a year where companies in the precious metals sector, after 7 years of getting valued down, start to get valued up. Um, and so there are many opportunities in that sector. And as you know, with regards to how we speculate with cryptocurrencies, Wealth Research Group in 2017 covered Dash at $30. It's over 1,000. People have made substantial gains, subscribers. Ethereum at $12. It's over $800 right now. I got a lot of people that send us snap pictures of their portfolios, or yeah, even two people sent us photos of their family vacation on a cruise because of what they've done with cryptocurrencies. Litecoin, we featured at $20. It's over $350.
Right.
Ripple 3 weeks ago at 27 cents. It's over $3 today. So that's a 10-fold move in 3 weeks.
Yeah.
That's substantial.
Really, it is.
And this Friday, so January 5th, we're releasing our top 5 cryptocurrencies for 2018, and that special report, I'm giving you access in your youtube.com/top 5, top and the number 5. And look, we found Monero in 2017, and we profiled that thing very, very cheap. It's our biggest winner. I think it's up over 4,000%, so 40 times your original alert from Wealth Research Group. And this was a huge year for cryptocurrencies. And what I want to tell you about cryptocurrencies is they present the last stage of a bull market. In other words, when you have so much money going into a speculative sector, it's the same as what happened with the NASDAQ rally and bubble. Cryptocurrencies should be viewed as technological startups. Some of them are good projects, some of them are bad projects and will not sustain. But the rush of money into them and the willingness to dabble with them, it is very typical for the last stage of a stock market bull market. So instead of going into NASDAQ stocks, tech stocks, people are going into cryptocurrencies.
Yeah.
This is another layer that shows you that there's a lot of speculative willingness right now, which is very typical of the late stages of bull markets. So you got another year or two to really capture these insane gains before things change around.
All right. So, Lior, we have another call. I want to see if this is a authentic call. Hello, caller. How you doing? I'm doing excellent. What's your name? Where you calling from?
I'm Dan. I'm on Denver.
Dan from Denver. What's your question for Mr. Lior Gantz tonight?
When do you guys expect this dollar to finally pop? Because I know there's a lot of manipulation, but just wonder when. Is it going to be pretty much this year? Or?
So you said the dollar, or what?
Yes, sir.
So when do you expect the dollar to pop? How long do you think this somewhat of a bear market will continue in regards to it being a little bit not as strong in comparison to other currencies? What's your thought, Lior?
Well, sir, the number one thing to remember is that between 2011 and 2017, the dollar has been on a bull market. It gained 35% in terms of its index, and therefore, if you look at the dollar's history compared to other currencies, it goes on a 7-year bull market cycle. It's done that 3 times already during the time that it's been free floating or a fiat currency not backed by tangible assets. So since 1971, you saw it 3 times go on a 7-year bull market, and the last one just ended. So we've been on one since 2011 to 2017. It's now 2017 was its worst year since 2011 in terms of decline on the index, and therefore you see a correlating move in gold where it's up and has its best year since 2010. If you're looking for it to pop, I think your expectations of it are too low, because the risk of hyperinflation is almost non-relevant these days. When the consumer in the United States and when small businesses are so confident, there is no genuine real risk of an hyperinflation in the U.S. Remember that 71% of the world's currency is the U.S. dollar, for good and bad, and 50% of the dollars in circulation are outside the United States. So for it to have a hyperinflation, foreign holders of the debt, so China and Russia and Japan and all the many governments around the world that hold the U.S. dollar, need to start panic selling.
Right. Fair enough. Now, would you say that since China and a lot of those countries have began investing a lot of their holdings into Africa, for example, on infrastructure spending, the Silk Road and things like that. Would you consider that kind of them not necessarily panic selling, but just easing off the brakes just a little bit by trying to and use them for investment purposes?
Well, people have been trying to make these simplified cases for years, to say, okay, if this thing happens, then this thing happens, this thing happens, then this happens, etc., and people will adopt the dollar, and it doesn't happen that way. In fact, in the last few months, more and more governments have come into the auctions and have bid for treasuries even more than before. If you and I were holding, pretend, Michael, that you're holding $2 trillion worth of United States government treasury debt. Would you liquidate it, creating an avalanche that other people will liquidate? You will lose $2 trillion.
Oh, of course not.
You know, it's
if I want to get rid of them, I would slowly but surely figure out a way to, reallocate them somewhere else, but yet not necessarily cause a panic where people want to sell while I'm trying to exit myself personally.
Sure. And so when you think of governments, if this happens on an international level, this is something that can create chaos, problems, war, conflict. These are not small boys playing with $5 bills. This is trillions of dollars, and societies and economies and careers on the line, everything on the line. And so what they would need to figure out is how to restructure what is created. Lots of the world is, if the dollar tanks, it's gonna die. You're gonna wake up, you're gonna go look outside the window. The building is still gonna be there. The road is still gonna be there. The car is still gonna be there. The dollar is a transactional currency. Right? You transact with it. It's a store of wealth for people who hold it as cash, but it's obviously not an effective store of wealth because it has been declining in purchasing power for more than 100 years at the factor of 95% reduction. So $1 in 1913 is 5 cents today, and even less to some extent. The world needs to find a better medium of exchange for 21st century global village. But until it does, the United States government will still have that luxury that they can print money that the rest of the world will accept, and therefore they will get to live that lifestyle where cheap credit is available, which is what people in America are so used to that they don't even realize that in other places in the world it doesn't happen that way. If you take a smaller country in Europe, like Romania, if they start issuing debt, they're toast. They're over. Nobody will buy the debt in such amounts like people and governments buy the US dollar, because they must buy the US dollar for transactions. They must hold reserves. Right. And nobody needs to hold reserves of a Romanian currency, for example. With regards to this person who came on from Denver and asked the question, I think what he needs to understand is it's not going to be an overnight event, and it's not going to be something that you wake up in the morning and you see, tanks in the street. But currency, the US dollar, is not something that you want to hold as a long-term asset. It doesn't have any use case for it to go up in value. It can go up in value against other currencies, but you've got much better alternatives of what to do with your money.
Right, fair enough. Now, I have a question offered by chat from Mr. Nicholas Smith. He said he wasn't able to call in, but he commented on your statements about what's happening in California with the whole marijuana situation. And his question is, he wants to know, in California, have you investigated thoroughly, and what are some of your thoughts on it, and what are some opportunities that those may have to invest in that type of thing happening out in California?
Well, California is the 6th largest economy in the world, so it's bigger than most nations. It has 39 million inhabitants, 50 million tourists a year. Tourists are a great source of cannabis consumption and demand, and the citizens of California offer another layer. Cannabis is used for both recreational and medicinal. Now, with both being legal, a lot of companies will come into California and will invest in R&D, so research and development, to find better and more consumer-friendly products for how to consume it recreationally, and better ways to use the active ingredients inside the plant on how to use it for pain relievers, sleeping problems, etc. All the things that the cannabis is already known to be effective for, but now you're going to have a lot more money to go into labs. Companies that are multi-billion-dollar companies will have they will have more reassurance that the federal government will not come in and close operations after you already spent tens of millions of dollars. So, and remember, July 1st, Canada is also legalizing. The trend is certainly to legalize, and California's legalization will show other states that if they don't legalize, their own citizens will take a flight to California and go spend dollars there and create a better economy there, and more taxes and revenue there, and you're going to be left only with an illegal market with lots of prison population that is what cannabis users. I mean, come on,
All right,
because that's happening in the United States. So it's boggled up with people in custody that are smoking marijuana or taking marijuana for their pain in their back or whatever, right?
right.
So in California, you've got a new economy, a new industry that already has amazing demand, because we already know from the illegal market that there's lots and lots of demand. But now it's going to move into the legal market. So you've got occupational opportunities from growing the plant to marketing it to real estate for warehousing and facilities for how to grow it and manufacture it and store it, etc. You're going to need banking services. It's a trickle effect. It's a multiplier effect on the entire economy. When you move something from the illegal market to the legal market, you create billion-dollar industries. Remember, it's now going to be as simple to buy wheat products as it is to buy beer. And for millennials, they love cannabis. It's a product that is part of their lifestyle. So there's lots of opportunities, and we have already covered in 2017 2 companies in the cannabis sector. One of them has tripled, gone from 40 cents Canadian to 140 cents Canadian, and another one is up 50% in 3 months. We're about to launch coverage on 3 new cannabis stocks in California in Q1 of 2018. If you hit the website and become part of the free newsletter, you're obviously going to get all that information published to you. But also go to wealthresearchgroup.com/cannabis profits, and you can see more information and more data about what's going on in the United States in terms of cannabis. Remember, it's going to be the fastest growing section of the economy, along with electric vehicles. These 2 industries are in hyper growth. So 20% a year growth, that's massive. And so lots of opportunities in terms of if you want to change your career and go into cannabis in California, lots of opportunities as an entrepreneur and investor.
All right. Now I want to turn the conversation a little bit towards the precious metal sector. Since 2018 has been within 3 or so days or so, precious metals market has gone up a little bit. Silver's up above $17. Gold has went up above $1,300. What's your thoughts on the recent increase, which has caused a lot of excitement for gold bugs and precious metal advocates? So what are your thoughts on the increase, and how high do you see it going, or is this just a little tease to keep those sound money people satisfied in the meantime?
Well, first of all, I do not take the position that the price of precious metals is so manipulated that they can play around with it to make people feel better or whatever. Precious metals are a global industry that in one day they trade about $250 billion worth of paper. And that's something that no one institution can control the price of. perhaps in the short term, in terms of minutes, or in terms of leverage, change people's towards it. But the free market price is pretty much controlled by investment demand. So if people are panicked regarding geopolitical events, they're going to buy more. Panic really becomes increased. They're going to buy silver, like you saw post the 2008 subprime mortgage crisis.
Right.
And so um, uh, the most important thing to understand is that gold is the only safe haven which is outside the banking system, and it's proven itself for thousands of years. And therefore, people will continue to buy it, but more so than people, institutions and governments will buy it, because that is part of a sound portfolio for them. In terms of not holding only other countries' fiat currencies, which are debt obligations, right? And so, when you see a move into an economy, a global economy, where China, in about 7 years, will become the number one economy in the world in terms of their size, and India is right after them, replacing Italy and England and France and all these European countries that don't subscribe to the gold theory as much as China and India and Russia, then you're going to see an economy where a global economy where gold plays a bigger role. You can see that already in 2017, where Ray Dalio is, just Google the name, he's the world's largest hedge fund manager, has taken a massive GLD position in Q1 and Q2 of 2017. He's now the sixth largest fund, is now the sixth largest holder of GLD, which is the gold ETF. And just figure this: the fund returns 21% a year for about 30 years. If you take 21% from today's price of 1,300, you're at 1,560. So this is what the smartest fund in the world is thinking that that gold might reach. And so you need to figure out your own things. But they are looking to make a trade out of it. So they're looking to make money. Most people, when they buy gold, they want to store it and never let go of it. It's a sort of insurance policy. Why would you sell an insurance policy? You don't want to get insured anymore. And so, no, it's important to understand. When you own gold, you own an insurance policy. The minute you sell it, you're no longer insured. So if you want to gain from inflation, from geopolitical events, if you want to be a chaos investor, you should think about how to look at the gold shares, the gold mining shares, because they're really, really cheap right now. Own gold as insurance, but go into the quality gold companies and take a look at them. Take a look at on who's consolidating, who's making moves, who's merging, who's the top quality companies, because those companies, they move in 1 year, they can move 3% and really make money for you.
Yeah.
If you're just looking for insurance, then just owning gold, for me, it's about 5% of my portfolio at all times. So if it goes up to more than 5%, I sell a little bit. I don't need 10 life insurance policies, right? And so there's a limit to how much insurance you would need. And if my equities position or my real estate positions become inflated versus gold, I buy more gold ounces. And so with about 10% or 15% of the portfolio, I speculate. I take larger risks with top quality companies. And through Wealth Research Group, I publish the personal research that I do into these companies. For example, in 2018, we are covering a company from Nevada where 4 out of every 5 ounces in the U.S. are produced. It's the most mining friendly jurisdiction in the United States, and they're gonna consolidate all of the or some of the mismanaged companies in that region to create a very well refined company. And these people are behind many successful deals that we've covered in the past. You can go to wealthresearchgroup.com/gold 2018 and check out this company's operations. I can tell you that the people behind it are the same people that launched Hive Blockchain Technologies, which was the first pure blockchain stock trading on the stock market that we've covered since day one. It started at 74 Canadian, 74 cents Canadian,
Mhm.
went all the way up to 675 Canadian. So it had a 900% move in about 3 months, Michael. And so there are ways to make money and big money in this economy because there are companies that are making power plays.
Right. Now let's talk about a little bit of the whole crypto sector, being that the coin market cap as of today is about 730 billion or 750 billion dollars. So we're approaching our trillion point pretty fast. Give me your thoughts on, how high will this market go this year, based upon your research and what your thoughts are, and give us some insight into how this whole crypto craze will play out. Will this be something that will last for a while? Is this just another .com bubble type of thing that some people might say? What are your thoughts?
Well, just remember, the .com bubble did not create a situation where all the tech companies are gone from the world and there's no internet.
Right.
So if an industry is viable, then people um, people invest in it. But if it becomes the story of the day, people invest in it or dabble in it or give too much credit to ideas. So in the .com bubble, you would see companies that have 2 or 3 employees, a great idea, and they get institutions calling them that they want to give them 50 or $100 million. 3 people that are inexperienced and have a nice idea not necessarily are worth 50 or $100 million of your money. And so when the sector gets heated up, like cryptocurrencies are, a lot of management teams that don't have the human skills to create a winning project are getting a lot of attention and a lot of money to play around with, and they're going to lose it. And so if you see 13 large number of people, and therefore these are not businesses, and they will probably wither away and die or get out competed by other better projects. So what you need to figure out is this this technology,
Mhm.
this distributed ledger technology, the database, the blockchain technology is going to be used in many industries. It's not going away. The cryptocurrencies or the project that use this technology, some of them have important value to our lives. For example, if you wanted to wire me money right now, you would do that in 5 seconds. In 5 seconds with some of these and pay no fees.
Mhm.
That's something that's really valuable for
Right.
billions of people worldwide. And so some of these projects will stay, but the name cryptocurrency or the name currency in them does not meet what they really represent. They're not currencies. Um, Most of them, they're projects that are similar to PayPal. They're means of exchange.
Right.
So if itself PayPal currency, right? And so
Right.
people are not confused there. So the branding of them as cryptocurrencies is a little confusing. What they are is startup booms, startup companies are involved in this new industry, and many of them, um, not part of our world at the end of 2018. Just take a
Mhm.
snapshot of your computer with all the projects that are now there, and you'll
Yeah.
see that at the end of the year, not all of them will be there. But
Right.
if you take a snapshot of your computer and see where some of them are trading, some of them will trade for 10 times what they trade right now, or 20 times, or 30 times, or 40 times, because they're mispriced. And if you see a good project that's mispriced, that is somewhere where you can make a lot of money because a lot of people are looking at these projects also, related money going into them.
Mhm.
And so as part of your speculative portfolio, which shouldn't be more than 10 to 15% of your net worth, because you don't want to lose more than that if you're wrong. That is something that is really powerful. And like I said, um, we're going to cover it big time in 2018, and we're also going to cover more blockchain companies. So companies that have to do with mining um, the actual coins, or making sure that there's equipment for all these companies to move forward. These are going to be something things that are going to be valuable. And like I said, go to wealthresearchgroup.com starting Friday. Go to wealthresearchgroup.com/top 5 for our top 5 cryptocurrencies for 2018, January 5th.
Fair enough. Now, as we draw towards the end of our conversation, I have a question from someone that's watching us now, and his question has to do with the link, or similar to precious metals as well as crypto. And it's if precious metals were allowed to find true price discovery, they would act more like cryptos are acting right now. What do you think about that?
I'm sorry, you got cut out like halfway through, so can you say that again?
Not a problem. You said if precious metals were allowed to reach true price discovery, they would act more like cryptos are acting right now. Do you believe that, or what are your thoughts on that?
Here's what I believe, and here's what I know from the numbers. Gold, right, of the currency supply, the global currency supply. Usually, in sound monetary policies, it covers at least 20%. So just judging by that, you can triple the price of gold to about $3,900 per ounce. If you want to create a situation where it covers 40% supply, which it did in the early 20s, then you're looking at about $7,800 per ounce of gold. And if you wanted to cover 100%, then you need to multiply it by about 14. And that will take it to a situation where it's trading for about $15,000 or $16,000 per ounce. And with regards to silver, the world resumes its position that silver is a precious monetary metal, because right now it's acting mostly like an industrial metal. Mm-hmm. If you ascribe it that premium that it does have, because it's the finest element in nature to be used as commodity-based money, and you create a situation where the mining ratio, which is about 9-1 from gold, is basically the ratio of value between them, then take the gold price, divide it by about 9 or 10, and that should be the price of silver. Now, people around the world do not view silver as a monetary precious metal right now. They're only the minority of people like us view it as an important monetary metal. So you're not going to see that overnight happening. But if you do, silver is the most undervalued commodity in the world. As a monetary metal, and ascribe a premium to it. You saw in 2011, it went up to $49 per ounce, though the production price stayed at about 17. So it had a huge premium above production price. Right now, it's trading just above its production price because no one is ascribing it a premium above its industrial uses. Mm-hmm. And so that's where I see gold and silver. Like I said before, if you're in the precious metals sector, investing sector, to make large sums of money from the fluctuation of price for gold and silver, what will you do when gold doubles? Will you sell your gold? If gold doubles, that means that the economy is not doing that well, and so that's why your insurance is becomes more expensive. And so it's something to think about when you build your gold portfolio. Maybe sell half your gold or something like that. You're still covered if something happens. So something to think about for your listener.
Fair enough. Fair enough. Well, Lior Gantz, man, I thank you for sitting down with us and chit chat with us. Typically, we have more audience participation. So tonight, a couple people mentioned that the line wasn't working. We had a little prank call. But other than that, it was still great to get your thoughts on what's happening. Now, before I let you go, give me some thoughts, just off the cuff. Give me some predictions on when we chat again at the end of this year, say summertime. What are your thoughts on the market cap for cryptos, as well as the possible price for gold and silver, if you're willing to go out, if you're willing to go out on a limb like that?
I would say the general trend for gold and silver is up. It will be up around 5 to 6 to 7% by summer if the trend continues, and it could be a little more if geopolitical events like in North Korea get more severe, or in Iran, or anything else that we can't foresee right now. And so for the summer, the trading range would be somewhere between the 1250 and the 1350 to 1400 for gold. And for silver, it would be somewhere between the 2223 and the 17 where it is right now. It's pretty much bottomed. You can't price a commodity below its production price, especially silver, for a long time. So you're in that range. For cryptocurrencies, I think it's going to be much higher, and not because of Bitcoin, but because of the other cryptocurrency altcoins that are creating much more value than what Bitcoin is right now. Bitcoin has a lot of challenges and troubles, and on the flip side, a lot of altcoins. Remember, these are technologies, so the more time goes by, the better the technology, and so their value will go up. Some of them, and some of them will wither and die, but it will still be the hot topic on the news.
Fair enough. Lior Gantz, thank you for joining us. And as well, you gave us a lot of links of things that the audience can go check out and get involved with. So I'm definitely interested in that. And before we hang up officially, I want to get all those links from you and put them in the description below so people can get in more in tuned and get educated on what's happening and have a chance to make some good earnings this year. So other than that, Lior, thank you for joining us. Look forward to having you on later down the month and see where we're at in the economy as well as all these markets and go from there. So thank you.
Thank you very much.